Most people believe taxes are unavoidable. Work harder, earn more, pay more. And once you see the 3 loopholes hidden inside that system, you'll never look at wealth the same way again. The first loophole is surprisingly simple. The rich try not to earn taxable income. They build assets instead. Most people rely on salaries. Every paycheck is immediately visible to the tax system. But a growing business, a piece of real estate, or company shares can increase in value for years without creating taxable income. This is called an unrealized gain. On paper, someone can become hundreds of millions of dollars richer while technically earning very little income. The system doesn't tax wealth that simply grows. It mainly taxes wealth that is sold. That leads to the second loophole, and it's one of the most misunderstood strategies in finance. Instead of selling valuable assets, many wealthy people borrow against them. Imagine owning company stock worth $1 billion. Selling it could trigger a massive capital gains tax. But borrowing against it doesn't count as income. The shares remain untouched, their value can continue rising, and the borrowed money can fund homes, businesses, travel, or investments. In many cases, interest on certain business-related borrowing may even have tax advantages. It's a strategy known as buy, borrow, die. And while the name sounds dramatic, the underlying idea has become one of the most discussed wealth preservation strategies in modern finance. A real-world example often associated with this approach is Elon Musk. For years, much of his wealth existed as Tesla shares rather than salary. Instead of receiving enormous paychecks every year, his net worth largely grew because the value of his stock increased. Wealth tied to appreciating assets is treated very differently from a monthly paycheck. Although Musk has also paid enormous tax bills when exercising stock options and selling shares, his wealth illustrates the broader principle. Asset growth and taxable income are not the same thing. Understanding that distinction is one of the biggest mental shifts in finance. The third loophole isn't really a loophole at all. It's hidden inside incentives. Governments don't just collect taxes, they also use taxes to influence behavior. That's why many countries offer deductions, credits, and depreciation benefits for activities they want to encourage, such as investing in businesses, building housing, funding research, or supporting charities. The wealthy often structure their investments around these incentives because they have teams of accountants and tax advisors who understand every legal rule. The average person fills out a tax return. The wealthy often design their financial lives around the tax code itself. This reveals a hidden psychological divide. Most people think money is about earning. The wealthy understand that money is about structure. 2 people can have the same net worth but face completely different tax outcomes depending on how their wealth is organized. One is rewarded for labor. The other is rewarded for ownership. It's the same economy, but 2 very different games. None of this means taxes are optional or that anyone can simply avoid them. Tax laws vary by country, change over time, and these strategies require significant assets, professional advice, and strict compliance with the law. But the bigger discovery isn't about paying zero tax. It's about recognizing what the system actually rewards. The greatest financial advantage isn't always earning more. It's understanding the rules that were written long before you entered the game. Because once you realize the tax code isn't just a bill, it's also a blueprint, you stop asking how the rich keep more money and start asking why almost nobody is taught the rules in the first place.